Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day, a wild day. Romaine Bostick, Caroline Hyde, Taylor Riggs counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast partners, Carol Massar and Tim Stenovic, bringing together our audiences across Bloomberg television, radio, and YouTube. A day that started off with pretty much a plunge all the way down to the depths of correction for the S&P, the NASDAQ, the Russell, and everything in between. 1,000-point drop on the Dow Jones Industrial Average, Carol. But here we are right now, everything in the green. Where are your mashed potatoes?
I'm going to be eating mashed potatoes. I am shocked to see the investor buying, and we're seeing broad-based buying into the close, especially when you've got, Tim, that Fed decision come Wednesday. I'll get my mashed potatoes, but I'm still waiting to see what the Fed has to say.
I mean, look, earlier in the day, the narrative that we were hearing was, okay, investors perhaps taking a step back and thinking about what happens and waiting to hear from the Fed. But hey, they'd rushed in and they bought that dip. The NASDAQ 100 up more than 5.6% from lows right now.
I thought a 4-day week last week was pretty long. I mean, this feels like 5 days in one day. Extraordinary. And I mean, does this mean Jay Powell can relax now come Wednesday? He doesn't have to worry about what the market's trying to signal to him?
Well, the market's certainly on the long end, Caroline, signaling the 10s, 20s, 30s yields. They are rising. If that's an indication of how we're thinking about growth and inflation on the long end, and the 2-year yield is only down 4 basis points to just 96 basis points. A 5-year yield mostly unchanged.
And I just want to point out, we've been talking a lot about sort of the trading range on the S&P 500. Right now, we've swung from peak to trough by about 194 points on the S&P 500. We talk about how that compares to the swoon in March 2020. 219 points. That was the biggest day that we had. That was March 13th of 2020. So we're not far off that in terms of the severity of the swing here. Of course, the severity this time, unlike March 13th, 2020, is we're going to end positive, believe it or not. The S&P 500, and we're going to take time to walk you through this, folks, because this is important. The S&P 500 was down 4% on the day. It's going to close higher by 13 points, or about 0.3%. The Dow Jones Industrial Average was down more than 1,000 points. It's going to close higher by 100 points, 0.3%. The Russell 2000 was down more than almost 3%, now going to close higher by 2.3%. And let's flip it up to the NASDAQ indices. Both the composite and the NASDAQ 100 were down almost 5% on the day. They're both going to finish in the green. The NASDAQ composite higher by about 0.6%. The NASDAQ 100 higher by about 0.5%, Caroline.
Yeah.
Carol, guess what's in the green? ARK Innovation ETF.
See?
By 2.8%.
You know what?
She's back.
You know what's remarkable about that, Caroline, is it hit a new 52-week low today. Just today, hit a new 52-week low, and now it's closing in the green.
Extraordinary.
Well, and what's interesting, Hank Smith of Haverford Trust was just on with us, and he said, listen, we've seen this technical correction. Certainly we saw it on the S&P 500. We've seen it in small caps. And at this point, investors are seeing opportunities. He used the word Tina, saying there is no alternative. What are you going to do? Buy the fixed income market? You're going to buy treasuries? You still have some outperformance in terms of the equity.
In fairness, people did do that earlier today.
Well, but look at how but look at how quickly they swung and walked away from it.
I'm just being cheeky.
I know you are.
Oh, cheeky,
Well
Romaine,
done.
your favorite
Well
word.
done.
Let's come back, Carol, and just dissect some of these equity markets for you. I know that we're also focused on the bond markets as well. Just from a sector level, this is a level 2 of the S&P 500 that we're talking about. This green was a lot more red than it was before the market closed. It is basically green in the green and red in the red. But the composition is really interesting because you're getting a mix of this. You're getting energy, but you're also getting food and staples. You're getting transportation, but you're also getting consumer durables. So you're getting a pretty broad range of the sectors, at least, that are in the green here. I'll bring you down to the red because the red still is pretty significant. A lot of this is food and beverage, but it's autos if you're thinking about the risk taking, and utilities if you're thinking, Carol, about those bond proxies as well.
Green in the green, red in the red. You paint a picture, Taylor. Meanwhile, we're going to get more, sort of trying to pick apart these extraordinary moves on the day. Let's get you an expert. Ed Clissold, Chief U.S. Strategist for Ned Davis Research. Give us your viewpoint. What happened? Why did the dip buyers suddenly come back around lunch?
Well, I think there's a few things. One is that clearly the hedge funds were net short. Looks like there's some short covering there. Then you throw on the algos who come in toward the end of the day. They did a lot of their trading the last hour, last 30 minutes. And so when the momentum got going to the upside, they added to it. But also, our sentiment indicators were showing the market was getting pretty washed out short term. So any sort of positive news was going to probably follow it up with a bounce.
Well, let's put this into perspective here, Ed, because last week you guys over at Ned Davis, and you guys do some great research, but you kind of put out a call here that kind of the best was behind us. And forgive me if I'm mischaracterizing it, but there was a general sense here that not only were we headed towards a full-blown correction, but there actually needed to be a little bit more of a shakeout in this market, primarily because of what we've been seeing or maybe not seeing this earnings season. Do you still stand behind that?
Yeah, we do. So the call from last week was really looking out a few months, really through the first half of the year, and saying that not necessarily we're going to have a major bear market, but the pace of gains are likely to slow, and you're going to get more corrections and more volatility, which of course we've seen over the past week. But one of those big concerns was that the remarkable earnings growth stories that we saw last year are probably made very difficult to replicate this year. During each earnings season last year, you got massive upward earnings revisions, great beat rates, or percentage of companies beating estimates. So far, we haven't seen that. It's early. Only about 12% of S&P 500 companies have reported. About 75% of them have beaten estimates. That sounds great. It's not bad. But last year, each quarter had over 80%, and we're approaching 85, 86% some quarters. So it's just not quite as good as it was before, and that probably will lead to more modest gains and bigger corrections.
Well, and Ed, what do you think is the biggest determinator in terms of where we go next on the equity trade? Is it the technicals? How closely are you watching that? Is it what we get in terms of earnings and more particularly outlooks from these companies? Or is it Fed policy ultimately, or a little bit of everything?
Yeah, it's going to be a little everything, but if I'm going to pinpoint one, I'll go to the Fed. This bull market was born of the Fed and their extraordinary measures, and it will probably die at the hands of the Fed. So we'll get a much better idea on Wednesday what the Fed is thinking. The market has moved from maybe a couple of hikes in 2022 to now calls for hikes every single meeting in QT. And so all that angst has probably added to the consternation over the past several days. Moving forward, maybe we'll have a little bit better idea of what the Fed is going to do. And then to take it one more step further, as we go out a few more months, we'll probably get a better idea of what inflation actually is going to look like this year. And that may give the Fed room to go a little bit slower than some are fearing the Fed's going to have to be.
And how do you balance then the higher yields, the research that you've done, the impact on lower net present value, with the alternative that we heard from Jeremy Siegel, professor over at Wharton School, with sort of Tina? There is no alternative. In the long run, equities are the inflation hedge. How do you balance that with what could be lower net present value?
Well, I think if you're looking at over the next few months or even about to a year, the speed of the interest rate changes really matter. So even if you go post-financial crisis, interest rates were low throughout the entire time. But if you got a spike higher, 100 basis points in the 10-year Treasury over a few months, the stock market took notice. So there's that aspect of it. Over the long run, if interest rates do remain low and the speed is modest, if we have a slow move higher in interest rates, stocks will probably do fine. For example, from the early 50s, when interest rates first started to rise, we went all the way to 1966, 15 years of a slowly rising interest rate environment before rates got high enough that was a problem for stocks. We probably won't have to go 15 years this time, but it does tell you that the market can work higher if yields are rising, as long as it's not too quickly.
Ed, help us understand what investors should be looking for from commentary from companies. We're about to be in the midst of earnings season. IBM today. Later this week, we're hearing from Microsoft, Tesla, and Apple, of course, just to name a few. What do you want to hear from these companies to tell you what the pulse of the U.S. economy is and the world economy and the consumer?
Yeah, I think we're going to need to hear a lot about Omicron and supply chains. But then the other thing I'm going to be listening to very closely are wages. That's going to have a big impact on the Fed. If we get wage push inflation or employees demanding higher wages because they think prices are going to rise for them, that's going to be a bigger issue. But also profit margins were a big driver of those remarkable earnings gains last year. Usually in the third year of an economic expansion, which we're going to be in for most of this year, margin expansion continues. But because we've already done such a good job on the margin front, if wages are a little higher, I wonder how much more margin expansion is out there. So wages and cost on that front are going to be key.
I'm interested in your take quickly, Ed, on retail versus institutional right now. How much do you think it's being, you'd say it's the algos that dictate trade. How much has retail really hurt?
Yeah, there are probably a lot of people who were new to trading, learned a lot of lessons over the past few weeks. So that may take some of the froth out of the market. Although institutions are probably taking their lumps as well. But it's quite possible. We've seen the peak of the Reddit group. We'll have to see how well they come back.
Ed Clissold, Chief U.S. Strategist for Ned Davis Research. Really appreciate the perspective here on days like today. Caroline, some breaking news as well on fundamentals.
Yeah, IBM coming out, and it's a beat with its fiscal fourth quarter revenue, $16.7 billion. The estimate had been for $16 billion. They're saying that is growth of some 6.5%, 8.6% if you're factoring in constant currencies. We're also seeing consulting revenue looking pretty healthy, $4.75 billion. This is revenue up to the tune of 16% in a constant currency basis. Software revenue, this is where all the analysts' eyes are trained. Software revenue, $7.27 billion. This is up, 10% at constant currencies. Remember, this is all as they've taken out Kyndryl, taken that bit out of the business and really doubled down on what is the future of cloud, of software, of consulting. Anurag Rana's with us, of course, Senior Software and IT Service Analyst for Bloomberg Intelligence, joining us on the phone. And dig into it with us, will you, for a moment? Because this is what Arvind Krishna's been talking about. He's been promising mid-single-digit growth, right?
Yeah, no, absolutely. So the two things that stand out to us is consulting growth and the improvement in software. And these are the two areas where, going into the quarter, we expected the consulting to be strong, but we weren't sure where the software is going to end because last quarter they had a blip in software. It's nice to see a recovery in that segment also.
Talk to us a little bit about the legacy business. We see that go down, and I think that would be a good thing. This is the infrastructure business. It looked like it's down 2% here on a year-over-year basis. How is the runoff of that going relative to the uptick that we're seeing with regards to software and other services?
So the infrastructure segment will go up and down, and that's cyclical as well as there's not going to be that much growth in that in any case. But the real kicker is how is software going to go going forward? I think the guidance that we're going to hear on the call is the most important thing for the company at this point because software not only brings good revenue growth, but it also brings really high gross margins, where gross margins in software are close to 80%. Where that in the infrastructure segment is only 50, and while in the consulting segment is only around 30.
Anurag, this is a company that has been kind of setting itself for the future, right? Selling off some units as of late. How nervous, though, are you that it hasn't put out an outlook, that it's going to talk about 2022 expectations on the call? What does that say to you?
I think, if you look at it from a macro point of view, technology spending is strong. It's actually very strong right now. It's one of the best that I have seen in the last 15 plus years. So from that point, we see no reason why IBM's consulting growth should not continue into next year. And so same thing for the software group. But we don't know what kind of margins that brings with us at that point. So I'm frankly not that concerned about the growth aspect. But one thing that I would say along with it is IBM still has a long way to go before it can match its peers when it comes to overall growth rate.
All right, Anurag Rag, I really appreciate you taking time to be with us, Senior Software and IT Services Analyst at Bloomberg Intelligence, breaking down IBM earnings for us. IBM shares higher by about 6%. The headline, Taylor, is IBM posting its best sales growth in 10 years on cloud demand.
We take a look at fundamentals from some of the individual companies and fold that into fundamentals of some of the markets that we got today. Let's do all of this with Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. And Gina, you just heard Anurag talking about some of the companies, some of the big tech companies we're starting to hear from this week. You fold that in to a tech sector that managed to close up 0.6% today, Gina. How are you thinking about the fundamentals in this equity market?
Yeah, so frankly, the fundamentals have been somewhat ignored as the market has been very much focused on monetary policy and what's going on in rates and duration as the primary factor really driving stocks over the last couple of weeks. So getting into the thick of earnings season should provide some degree of welcome reprieve for the equity market. In particular, this week of earnings, we get the most S&P 500 companies reporting this week. We get all of the giants in the tech space, Microsoft, Apple, as well as Tesla. Next week, we'll move to communications. So provided that these companies can be like IBM and beat expectations, and importantly, if they can guide for better growth going forward, in particular on the margin lines, it could provide a welcome source of stability and some reprieve to the endless selling that we've been experiencing for the last couple of weeks.
The flip side of that is we see another situation like we saw with Netflix Thursday after the bell when Netflix reported. Gina, you have a new note out from you and your team this morning. It's saying that tech is in trouble as top and bottom lines trail S&P 500's pace. What specifically are you seeing that shows you that tech's in trouble?
Yeah, so the problem that tech faces is for most of the last 5 years, but especially the last 2 years, tech has produced faster than S&P 500 revenue as well as EPS growth. That has flipped for the first half of 2022, at least maybe all of 2022. The consensus is expecting tech to continue to produce faster revenue growth than the S&P 500, but slower EPS growth than the S&P 500. At the same time, the space commands a gigantic premium. So those two factors don't really jive. How can you have slower than S&P 500 EPS growth, but a bigger premium than the S&P 500? Well, you only can do that if you can convince investors that this is a short-term phenomenon, that longer term you will see much stronger revenue growth ultimately manifest itself in much stronger EPS growth. And that's why I say you want to focus really exclusively on what's happening with margins, because that's what's creating that downdraft. Is they're still producing incredible revenue growth, but they're not getting it all feeding through to the bottom line. So the companies do need to manage costs really carefully. They need to convince the consensus that they're going to be able to do so going forward. And they might be able to produce a little bit of share buyback upside to EPS as well. That could certainly improve the outlook.
Is there going to be a difference this time around, Gina? And we're in conversation right now with Gina Martin-Adams, Chief Equity Strategist for Bloomberg Intelligence. Is there any sort of difference this time around, this earnings season and the earnings seasons the next couple out, where when we talk about cost cuts and whether it's just, slashing the number of folks on your workforce or trimming some other costs around the edges, that's going to be sufficient enough given that so many of the cost pressures, upside cost pressures, are coming more from the supply side this time than on the demand side?
Yeah. No, what they do need to do is give us some confidence that the supply chain constraints are going to ease. I mean, frankly, the little minor cost cutting around the edges is not going to be enough to produce that sort of really significant change that I'm talking about. What we need is some resolution of supply chain. And this is what makes this such an uncertain environment, is supply chain has been a huge part of the cost pressure. We also, I think, need a little bit of confidence that wages will not get out of control, that sort of labor force movements are not changing dramatically. We saw some weakness evolve in the financial sector as a result of some of the JP Morgan comments about wages and sort of the stickiness of labor. So I do think we'll have to get some confidence out of tech as well, because labor is a very big part of their input.
Well, Gina, just to follow up on that, I'm curious about the supply chain side and the commentary that we're starting to get now out of some of these companies, particularly as we get into some of the more consumer-facing companies here. So far, we haven't heard a lot of companies say that things are better, or at least not dramatically better here. What are you expecting to hear going forward from some of those consumer-facing companies?
I think it's going to be a lot like what we heard in the third quarter, which is not yet. And that was unfortunately a little bit disappointing for the market, which was expecting by the end of 2021, we would ultimately have resolution to the supply chain constraints. But largely due to the Omicron virus popping up, really taking the sort of supply chain consensus by surprise, we have this sort of extended supply chain weakness. I think we want to hear from the tech companies how they might be considering about contending with this longer term. And what I mean by that is this is a space, and the market at large has been caught in this trap of very, very low capital spending, sort of really, really constrained spending growth for a long period of time. One of the big upside surprises I think we might start to hear, and we did start to hear this in the third quarter, is companies actually coming back to market, spending money to improve the supply chain dynamics. Spending money finally on CapEx ultimately feeds through to better growth longer term for most sectors and industries. in the economy. Companies are still sitting on a lot of cash, and investors are going to want to know what they're going to do with that cash. Are you going to spend it on buybacks like they did in 2021? Or are you going to continue to start to really edge back into spending it on capital spending? Because that has much stronger positive impacts throughout the entire tech, industrial, even materials complex of the world, which could provide us with some degree of upside. I think on supply chain, if all you're going to do is sit around and wait and sort of navigate around the edges for things to go back to normal, I'm not sure the market is going to be terribly happy with that response.
The market waits for no one. Gina Martin-Adams, always great to get your expertise on days such as this. Chief Equity Strategist for Bloomberg Intelligence. Carol.
All right, that's going to do it, folks. What a day. And we'll see what tomorrow brings, whether or not we see a continuation of the move up or whether...
Enjoy your mashed potatoes.
There it is. I was waiting for that.
Everybody's waiting for the video. Oh, man, not fair. All right.
Photo or it didn't happen.
Exactly. All right, we're going to catch you again, same time, same place tomorrow on radio, on TV, and on YouTube for our cross-platform coverage. This is Bloomberg.